When you actually try to fight inflation, the economy melts down because we financialize the whole system. Asset bubbles have become such a huge part of the economy and the economic growth function that once they collapse, the entire economy falters. So that's the dynamic that we have today.
This is Kaiser Johnson with Liberty and Finance, and these are the Miles Franklin Weekly Specials for March 17th through March 24th, 2025, while supplies last. First this week, we feature backdated 1-ounce gold Krugerrand at just $59 over spot. Next, Valcambi silver kilo bars are just $2.20 over spot per ounce. Pre-65 mixed junk silver is just $1.99 over spot, and pre-65 half dollars are just $2.25 over spot. To order our specials or any of the many other options we have available, call us at 1-888-81-LIBERTY. That's 1-888-815-4237. We're available after hours and on weekends, and we look forward to speaking with you.
Welcome back to Liberty and Finance. We're always delighted to have this popular returning guest. Michael Pento is the founder of Pento Portfolio Strategies. He is an active money manager. He joins us regularly on Liberty and Finance. Michael, thank you for joining us this Thursday, March 20th, 2025.
Hey, it's always a pleasure to be with you, Dunian.
Well, that's how me and viewers and subscribers feel about your visits here. And one of the things that we love, and I tell you this almost every time, is that you are, well, first of all, you're down to earth and you're looking at real signals for forward-looking indicators. A lot of people, they know where we've been because they can feel it in their pocketbooks and they see it in their bank accounts and everything like that. But what they don't know is where we're headed. And that's where you tend to help give us some clues that you see in the tea leaves of what's coming ahead based on the forward indicators that you look at and follow. One of the things that's been interesting and getting a lot of news and buzz is attempts by the Trump administration to cut government spending, although not in all categories. Sounds like defense is going up and other things may be coming down and trying to find sources of egregious waste that they can eliminate, etc. Does any of the narrative or activity that churns out of Washington factor into the model or the decisions that you make? Are you still simply watching the numbers, looking forward, and primarily, judging where you see things headed based on what the actual data is, telling us out of the forward-looking indicators that you follow?
Well, I think it's one and the same thing. So I took down the exposure in the portfolio in late December of 24. One of the reasons why I did so is because of the prospects of the government shutting down. And we saw Chuck Schumer do an about face. One day, it was like Thursday, he said, or Wednesday or Thursday of last week, we're going to shut the government down. And then Friday, we're going to keep it open. Well, shutting the government down, there's a lot less spending when the government shuts down. And that directly feeds into the model. So when he did his about face, guess what? I took my shorts off the portfolio. I had one short, an anti-beta play actually, and I still have a short in junk bonds. But I went slightly longer and I took off some short exposure, the anti-beta exposure, because I thought we might have a bounce heading into the end of the usual paint the tape end of month, which is now the end of the quarter. So I'm less bearish right now, but I can tell you all the reasons why I think this is a very short-lived reprieve, if you want to hear them.
Yeah, we definitely want to hear those. You made me chuckle because we have interviewed on a recurring basis constitutional attorney Dr. Edwin Vieira, and prior to this election, he said, Harris would be a catastrophe, Trump would be a calamity, because there certainly is a lot of chaos and change of direction and false signals. And that's not unusual in Washington to have a lot of posturing and political theater and everything before they come down to the okay. Well, so we'll all sign the bill for a spending increase or whatever. But aside from that, there's a lot of extra chaos.
Well, they signed the continuing resolution, which keeps spending at the same level it was last year. So where are the Dunnigan, where are the cuts? You know, the February deficit was 2 times revenue. An incredible phenomenon. So it's 200% of revenue in 1 month. And that's the spending you want to keep in place? It's just mind-boggling. Oh, can I just, before I forget, I hope I don't forget, but so I won't forget. In case I do forget, which I probably would, I have to mention this. So we had a little bit of a comedy show when the Federal Open Market Committee had their March meeting yesterday, right? So Jerome Powell has this projections of when he's going to get to this number and when he's going to get to that number. So he projects he's going to achieve his inflation target sometime in 2027. And that would mean that the Fed would be north of 2%, above its 2% target for 6 years. And then, and using the cookbooks. And then I said to myself, wait a second. So he says, everything we do is in the responsibility and the pursuit of happiness and the joy of the middle class and blah, blah, blah. That's what he always says. You know, that was my paraphrase. All we do, every function, every thought process is to how we benefit the middle class of the United States and the poor and to keep prices stable, blah, blah, blah. And then he says he's not going to reach his inflation target for 6 years. And here's the punchline in the joke. And he's in a rate cutting cycle. So wait a second. I mean, why is it that, you know, I'm not invited to any of those meetings, Dunnigan, as you know.
Heck, you're not even invited on the mainstream media anymore, Michael. You might as well give up on being invited to the Fed Open Market Committee.
No, really not. I mean, Newsmax and maybe occasionally on Fox News, but not really. But so the next question from the next reporter is like, Mr. Powell, you said you're not going to reach your target for 6 years, your inflation target for 6 years. Why are you in a rate cutting cycle? That would be the only question that he should ever have been asked. But no one even paid attention to that. Sorry, that's my rant.
I think it's extremely important to all of our viewers and subscribers because we're going to be interviewing Dr. Judy Shelton, who's been a sharp critic of the Fed's greater than zero inflation target by policy. And she even gave us the insider's backstory of the conversation, including Yellen and Greenspan and all that, where that was determined that stable prices mandate that they have, one of their multi-pronged mandate means that they can pick a stable rate of inflation, not alone that they're going to cook the books to make that look lower than it really is, but that's going to qualify as stable prices. And as you know very well, and as you have explained to us over and over again, that inflation, even if it's at a constant rate of inflation, means you don't have stable prices. Otherwise, it would be zero. So anyway,
it's a second derivative of stability, but you're still destroying the purchasing power of the dollar. So the stable prices, that's what the Fed 1913 charter said, you know, full employment, stable prices. Stable prices in my definition of stable is 0%. 0% inflation. But they've tacitly admitted that 3% is okay. That's where inflation is right now. Core inflation is 3%. That's okay. But it's not 3% because it's, as you said, it's 3% the way they measure it. If you measure it, you know, like they did in the 80s, it's closer to 8%. So we don't have stable prices. And somehow this gentleman thinks that he could prevaricate and obfuscate to the American public and tell them how they're protecting the value of the dollar. No, you're not. You're not protecting the value of anything but the value of banks' assets on their balance sheet. That's what you're protecting, Jerome. And you're not fooling me, and you're not fooling Dunnigan, and you're not fooling anybody listening to this. The only thing you care about is keeping asset prices inflating so they don't erode in value, so banks' balance sheets appear to be solvent.
So they don't erode in nominal terms. Doesn't necessarily mean in actual value. The other thing is that he's not saying out loud. One of the quiet parts is that the Fed, he's making it like it's the people's bank and it's the bankers' bank. And secondly, the the other thing is that at the rate of 8% real inflation or destruction, theft, we can call it central bank theft, that means that every 9 years, half of everyone's earnings, savings, and retirements are being cannibalized. We have numerous people living in our 55 plus community where we live who are now putting their homes on the market. And at least one of them told us, he said, 2 years ago, I met with our financial planner. He said, "You're on the glide path. You just maintain your current expenses, and you're good to stay retired. Everything's good. You got a good balance projecting forward of your income and outgo. You can stay retired." And then 1 year ago, they told me, actually, with your property tax going up and your HOA fees going up and the cost of living going up, you're going to have to go back to work or sell your home and downsize your lifestyle. And this is happening over and over. When we moved here, there were 4 homes for sale in our community. Now there are 39, and this is really hitting the middle class hard. That's point number one. Point number two is this whole notion of stable inflation that they're understating is by design, by policy, theft of people's life, their nest egg. And we've talked with multiple people who are calling in and trying to get out of dollars and into something that maintains that value, as you said, real assets, that kind of thing. So it's a troubling phenomenon when those whom are in the positions of supposed to be stewards of our financial futures are basically lying to our faces and telling us that they're for us when they're not.
I hear some of the talking heads on CNBS et al. And they say, well, inflation is not a problem because real incomes are positive. And I thought, wait a second. So incomes are rising faster than inflation, according to many talking heads and many associated with big banks on Wall Street and Federal Reserve officials. And then you brought up a great point, and I've written about this. So, okay, maybe some people's salaries on a median basis are keeping up with inflation, but what about the 7 point whatever million people who are retired in this country? Are their incomes keeping up with inflation? And what about all those people who are underemployed? We're working for minimum wage. The millions upon millions of people who are not keeping up with inflation. Like you said, people are having to sell their homes because home affordability is at a record low level. And that's all laid at the feet at Mr. Powell. Everything we do is in the service of the middle class of Americans. No, that is a lie. And I think he knows better. And we all know better now. If you thought before you listened to this podcast that was the case, how is it then that home affordability is at a record low? How is it that real incomes for most Americans are plunging and have plunged? And it's because the destruction of the purchasing power of the currency has gone in overdrive. It started really in 2000. You can even go back to 1987, but it went into overdrive, global financial crisis, post the global financial crisis, and then post-COVID. And it doesn't look like it's slowing down because we have central bankers who still maintain that they've done a great job with bringing the second derivative of inflation down from the way they measure 9 to 3. But in reality, it's gone from 20 to 8, and it's still eviscerating the middle class.
This is where I was going with that. Right in line with that is this unspoken truth that I don't hear any of the, other than Ron Paul used to, but nobody currently seated there is bringing up, and that is the people will ask. They'll call me and ask. Clients will call me and ask. Well, we got a new sheriff in town. Trump's going to clean house, and they're going to cut the deficit and that sort of stuff. So aren't all our happy days ahead of us now in terms of finances? I don't hear anybody from Washington when they're talking about when they rarely talk about the cost, the actual impact of inflation, price inflation on ordinary people's lifestyles. They don't point to the root cause of it being the destruction of the currency by policy, by fiat central banks, not only in the US, but around the world. They'll point, oh, it's corporate greed. Oh, it's shrinkflation. Oh, it's Putin. Oh, it's, they'll point all over the place, but they won't say, it's like in Harry Potter where nobody could say Voldemort because that's the one who must not be named. You must not name that it's the central bank theft by design and by policy, destroying your earnings, your savings, and your retirement. All of these other things are signs and symptoms, but we'll put in a hotline so you can call in if you see any price gouging.
And why do they do that? I mean, I don't think I don't think it's nefarious in nature. The reason why central banks have an inflation target, the reason why the Federal Reserve took the amount of high-powered money, or think about it as the Fed's balance sheet, from $700 billion prior to the global financial crisis to over $9 trillion. The reason why they did all that is because government spending is out of control. So if the Fed or any central bank didn't increase the amount of base money supply or high-powered money, and that didn't allow private banks to monetize the debt, the Fed monetizes government debt and uses private banks as a conduit to do so. Okay, they create reserves. Reserves are given to banks. Banks use the reserves to buy bonds, and it's a vicious cycle. And the reason why they do that is because the government spending is out of control. And we have a $2 trillion deficit in good times. There's no recession right now, supposedly, right? Unemployment rate is historically very low. But we have a national debt. It's 123% of GDP.
I just have to interject. The unemployment rate, when measured by not the workforce participation,
right,
but by people who haven't given up yet, trying to find proper, adequate employment. Go ahead.
Right. Well, so it's the U3 and U6 is what you're talking about. There's measurements of various ways of measuring unemployment. But listen, if everybody stopped looking for work because they gave up because they couldn't find it, the unemployment rate would be zero. That's the way they calculate it. So, but supposedly we're being told that we're not in a recession and the unemployment rate is historically low. But why do we have $2 trillion in deficits? Why do we have $36 trillion, almost $37 trillion in debt? I'm not talking about unfunded liabilities. I'm talking about just debt outstanding, 123% plus of GDP. When you have those kind of numbers, the central bank really isn't looking out for you. They're trying to keep the federal government solvent, and that's why that's why we have inflation. The government's an extremely horrible distributor of capital. They create imbalances in the economy. That's what they do. I mean, the government doesn't have any money. The government has nothing. They steal the money from you, or they borrow money that is printed by the Federal Reserve and private banks. That's how the system works. And that's why we have now an intractable problem with debt, and thus an intractable problem with inflation. And the only benefit we're going to have from we might see a recession, which brings interest rates down temporarily. But God help us, Dunnigan, on the other side of the next recession, when the deficit is going to rise close to $6 trillion. That's an annual budget deficit. That's my estimate based on prior recessions and the effect on the annual deficit. Could you imagine that? $6 trillion? So coming out of, I'm going to talk about the Fed put for a second. So everybody's now saying, well, the Fed has your back. The Fed is put in full force, blah, blah. Let's talk about the Fed put for a second, if you don't mind. The Fed put, I'm pretty sure we had a fully functional central bank in the year 2000, right? The Federal Reserve took interest rates from 6.5% in 2001 down to 1% by 2002. Did that stop the NASDAQ from going down 80%? No. Did it stop the S&P from falling 50%? No, it didn't. So let's fast forward to 2008. The Fed started cutting rates from 5.25% in December of 2007. Took them down to 0%. 0%. Did that stop the S&P 500 from losing 57% of its value? No. Did it stop home prices from dropping 33%? nationally? No, it did not. So what Fed put are they talking about? The Fed always acts based on lagging economic data that's reported a month behind. So you have inflation that was created post-COVID that led to record high inflation in this country. And the Fed is saying, oh, well, we kind of have an inflation problem, but if they were actually forward thinking, now I don't want them to do this. Listen, I prefer that the Eccles building close its doors. I'm just saying if they actually had models that work, they would be ahead of these bust cycles, these disinflationary and deflationary cycles, but they are not. And it's the same thing is going to happen again. The Fed will be acting to pump up asset prices after the market's down 20%, but it'll be too late because monetary policy works with a lag. And like I said, now the next time the Fed takes interest rates to zero, and they will, the next time they undertake QE, and they will, the next time the Treasury and the Fed get together and send out, legions of helicopters to bring checks to people, helicopter money, and they will, I have no doubt. Where do you think inflation is going to end up then? Because who's going to believe them that they actually have any plan or ability to control inflation? When you actually try to fight inflation, the economy melts down because we financialized the whole system. Asset prices have become such a huge part, asset bubbles have become such a huge part of the economy and the economic growth function that once they collapse, the entire economy falters. So that's the dynamic that we have today.
That's the other false thing that most people watching the evening news or the mainstream financial press don't get because it's not said out loud. And that is that when we have this much public funding by debt of the so-called GDP, and that masquerades as actual economic activity. It's not economic activity. It's just government theft. I wanted to underscore something you said a few moments ago about the government doesn't have any money. It's a lovely quote from Margaret Thatcher. Let us never forget this fundamental truth. The state has no source of money other than the money which people earn themselves. If the state wishes to spend more, it can only do so by borrowing your savings or by taxing you more. It is no good thinking that someone else will pay. That someone else is you. There is no such thing as public money. There is only taxpayers' money.
So then again, so here's a beautiful quote by Margaret Thatcher, right? Good friends with Ronald Reagan, both great individuals. So the zeitgeist of today is you listen to CNBS, they'll tell you, you'll hear everybody says the same thing. Well, if only the government would stimulate. We need the government to stimulate. Germany is going to rack up the debt right now. They're going to, forget about fiscal prudence in Germany. They're going to borrow trillions of euros and build up their defense. And that's supposed to bring out, that's supposed to engender record growth and prosperity forever and ever. Amen. But when government does this because they have no money, they're borrowing it from you. No, they don't really do. They don't really borrow from you. They're not robbing. They don't really rob private sector savings. They don't tax it. They're not raising taxes. They do it with fiscal deficits. They borrow it from central banks. So in the long run, it kills productivity and it creates intractable inflation. That's the example, even in Germany, in Weimar, Germany, that is what they did. They borrowed tons of money in World War I, and they try to pay it all back by printing money. I can't think of a bigger government stimulus plan, a more perfect stimulus package than war. It's the most asinine way to spend money. It's the most destructive, evil, wasteful way to spend money. That's what government does. And at the end, you have intractable inflation and depression. That is what you get when you stimulate by deficit spending.
Michael, the indicators that you watch looking forward, you've often kept us apprised of where you see things heading in the next several quarters to a year. What are you looking at through the rest of 2025 and into 2026? We know Powell says whatever, highly unreliable that they'll be able to get any inflation, or the inflation will be down in until sometime in 2027 to their target. But what are you seeing?
Well, the Fed, even the Fed, finally they lowered their GDP forecast, their growth from like 2.3 to 1.7%. So they did take their growth forecast down. Listen, I'm very I think 2025 will be very unimpressive GDP growth, if not an out and out recession. So I can tell you the next couple of quarters, because of tariffs, which are taxes, which create friction in the economy.
Let me interject. I have to ask this. When you say anemic GDP growth in 2025, tell me, the Fed probably reports that in nominal terms, meaning if in real terms we're getting a destruction of the value of the dollar by 8% per year, then is a nominal growth of 1.7% in the GDP, is that actually a contraction?
No. So the Bureau of Economic Analysis reports the GDP numbers, and they are both reported real and in nominal terms. So when I talk GDP, the Atlanta Fed has real GDP at minus 1.8% for Q1, and I think that's probably closer to the truth. What we're going to see annual growth, real growth of zero, close to 0% this year of real growth. Due to tariffs, due to, thank God, finally shutting the border down, so we no longer just letting everybody in this country. We don't have any idea if they're terrorists, if they're whatever. We now have border closures, which is a contraction in labor force growth. That's half of GDP growth. So you have that and the tariffs. You have liquidity. The massive $6 trillion of liquidity that was created by the central bank post-COVID is finally running dry. See, reserves in the system are coming down. The reverse repo facility is from $2.5 trillion, $2.2 trillion down to basically zero. The Treasury General account is down to about $500 million. $500 billion, sorry, not $500 million. Banks are now tightening lending standards. The real Fed funds rate has been positive for over 2 years. So these are the liquidity metrics that I look at to show me that we might have a real serious problem, not just with disinflation, which I think is a wonderful thing, especially when you're going from 9 to 3. That's wonderful. But disinflation could morph into deflation and a contraction in asset prices. You have a profound reverse wealth effect now hitting this country. Home prices are starting to roll over on a month-to-month basis nationally. I mean, I live in Naples, Florida. I have a house in New Jersey. I have a house in New Jersey that I was told was some number, and I've lowered it by 10%, and I still can't sell it. That's New Jersey. In Florida, you had a great anecdote, but every single day in my community, the homes listed are not selling, and they have price reductions on a daily basis. Some home will lower their price, and they're not moving yet. So you think about all these people that were geniuses when they borrowed money at 3%, and then they bought an investment property and rented it out to somebody, and the home price was going up 20% per annum, and they were all geniuses, Dunnigan. But then when you have a recession and the renter stops paying you and the home price begins to roll over, you're up 100% on this house in the last few years, right? And you don't have to move, Dunnigan. You just call the real, hey, get rid of that house. I don't have to change my address. I don't have to buy new furniture. I don't have to do anything. I just call my realtor and sell the house. There's a tsunami of investment houses going to flood the market. Don't forget, these houses that you think you have 100% paper gain on, you've been paying taxes and insurance and maintenance costs. So when there's a totally different calculation for the investor when they say, I'm okay with these massive taxes, right? You can't homestead an investment property in Florida. So just so you're paying the higher taxes, you're paying the insurance, you're paying the maintenance costs, and it makes sense to do that when the home price is going up 20%, not when it's falling and you're no longer getting a rental income. So the reverse wealth effect from home prices, which are finally rolling over, and the fact that the S&P 500 is down and the NASDAQ is down on the year, and depending on what you own, if you own the high volatility sectors like Bitcoin, you're even down even more. So we have the reverse wealth effect. So I think GDP in real terms could be closer to zero this year. And when you have a GDP close to zero, even though it's not, might not be, I'm going to say it's not going to be a recession, even though it might not be a recession, it's very hard to get earnings growth of 12%. That's what Wall Street projects. When you have GDP that's flat, it's very hard, unless you get a tax cut, which you're not getting. The best you're going to get this year on the corporate level is the stasis. It'll be the same tax rate. So how are you going to get 11% earnings growth when the consumer on all cohorts, not even the bottom 4 quintiles, all 5 quintiles are now pulling back on their spending? So that means that the stock market is fully valued and still in danger of dropping 10, 20% this year if there's no recession, and much more if there is one, like maybe 40%. And the Fed put, as I just proved to you, is a figment of the imagination of Wall Street banks. It does not exist because the Fed always acts in arrears.
Michael, you have, as an active money manager, the ability to bring more people under your wings if they want to have you shepherding their funds or part thereof. How would people get a hold of you if they want to take advantage of your services?
There's a contact page on the website, mpento@pentoport.com. If you are suitable for the portfolio, because it's a long-short strategy, and you have $100,000 to invest and you're a U.S. citizen, you can contact me there. Contact our team and we'll set you up. You have to have a $100,000 minimum. That's the only caveat. Also, if you don't have that, I don't leave you, if you're not wealthy enough for $100,000, I don't leave you hanging. I give you a podcast, which is $50 a year. I give you the salient data of the week and what I believe is an unbiased, correct interpretation of the data. So whether it's bullish or bearish, I'll tell you what it is, what you need to be looking at, and how to interpret it from a 36,000-foot level.
Yeah, one thing that I want to underscore about you, from our viewers appreciate that, is that you're not a perma bear or a perma bull or just a gold bug or not a gold bug. You're a guy who looks forward and says, where are we going and what do we need to do to position ourselves to take advantage of what's coming and to try to stay out of harm's way as much as realistically possible. We appreciate that. That's part of that preparedness aspect that we've been about since we started this channel in 2013. And that's why you keep coming back on here, and our viewers appreciate your visits here with us. So folks, if you don't want to miss a single episode with Michael, make sure that you're on our free mailing list. Just go to libertyandfinance.com. That's our website, Liberty and Finance, all spelled out, all one word, libertyandfinance.com. Put your email address in, click submit. Make sure you confirm. On the confirming email, you'll get 1 email in your inbox per day. We won't share your email address with anyone. You keep your privacy and it's all free, but you'll get every interview with Michael and all of our other guests and any weekly specials. You won't miss a thing. Michael Pento, active money manager at pentoport.com. Thanks for joining us here again on Liberty and Finance.
See you soon, Damian.
This is Kaiser Johnson with Liberty and Finance, and these are the Miles Franklin Weekly Specials for March 17th through March 24th, 2025, while supplies last. First this week, we feature backdated 1-ounce gold Krugerrand at just $59 over spot. Next, Valcambi silver kilo bars are just $2.20 over spot per ounce. Pre-65 mixed junk silver is just $1.99 over spot, and pre-65 half dollars are just $2.25 over spot. To order our specials or any of the many other options we have available, call us at 1-888-81-LIBERTY. That's 1-888-815-4237. We're available after hours and on weekends, and we look forward to speaking with you.